Imagine stepping into a race where one runner spends every second changing shoes, switching lanes, and chasing whoever happens to be in first place. Another runner simply keeps moving forward at a steady pace, barely attracting any attention. At first, the exciting runner seems impossible to beat. The crowd cheers every move. The headlines follow every sprint. But when the finish line finally comes into view years later, it's often the quiet runner who wins. That is the story of index funds. For decades, investors have searched for the perfect stock, the next market superstar, or the fund manager who can consistently outperform everyone else. Entire industries have been built around making investing feel complicated. Financial television runs 24 hours a day. Analysts publish thousands of reports every week. Investment firms hire armies of economists, mathematicians, and researchers to predict where markets will go next. Yet, one of the most successful investment strategies ever created asks people to do almost nothing. No constant trading. No guessing the future. No trying to outsmart millions of other investors. Just quiet, disciplined patience. At first glance, that sounds almost too simple to be true. But history tells a remarkable story. In 1976, an investment company called Vanguard introduced something that many people laughed at. Its founder, John Bogle, launched the first index mutual fund available to everyday investors. Critics called it Bogle's folly. They argued that nobody would willingly settle for average returns. Their logic seemed reasonable. If you could hire professionals to beat the market, why would you ever choose to simply match it? The answer would take decades to become obvious. To understand why, imagine walking into the world's largest orchard. There are thousands of apple trees. Some will produce extraordinary fruit this year. Others will struggle. If someone asks you to predict which individual tree will become the best 5 years from now, your chances of being right are surprisingly small. But if you owned the entire orchard, you wouldn't need to guess. Some trees would disappoint. Others would flourish. Together, the orchard would continue producing apples. An index fund works almost exactly the same way. Instead of trying to identify tomorrow's winners, it buys small pieces of hundreds or even thousands of companies. If one business fails, others continue growing. The investor benefits from the overall progress of the economy instead of relying on perfect predictions. It sounds simple because it is. But simplicity should never be mistaken for weakness. History had seen this lesson before. Long before index funds existed, economist Harry Markowitz introduced modern portfolio theory in 1952. His research demonstrated that diversification wasn't merely about owning many investments. It was about reducing unnecessary risk without sacrificing expected returns. In other words, you don't have to put all your eggs into one basket to achieve attractive results. Markowitz's work eventually earned him the Nobel Prize in economics. Around the same time, another powerful idea was emerging. Researchers such as Eugene Fama developed what became known as the efficient market hypothesis. While the theory remains debated in some areas, one of its central insights transformed investing forever. Financial markets absorb enormous amounts of information incredibly quickly. Every second, millions of investors analyze company earnings, government policies, interest rates, technological breakthroughs, geopolitical events, and economic data. That means consistently finding bargains before everyone else becomes extraordinarily difficult. Imagine trying to beat the world's best chess players while they are all sharing information with each other every second. That's essentially what active investing attempts to do. Then something unexpected happened. Researchers stopped asking whether a few exceptional investors could beat the market. Instead, they asked a more important question: can most investors do it consistently? The answer turned out to be surprisingly disappointing. Year after year, study after study found that the majority of actively managed funds failed to outperform their benchmark indexes over long periods, especially after accounting for fees and taxes. One of the best-known reports comes from the SPIVA scorecard, published regularly by S&P Dow Jones Indices. Again and again, the data has shown that most professional fund managers underperform broad market indexes over 10, 15, and 20-year periods. This doesn't mean professional managers aren't intelligent. Quite the opposite. Many are exceptionally talented. The challenge is the competition itself. They're competing against other highly intelligent professionals with access to similar information, powerful technology, and enormous research teams. Small advantages disappear quickly. Meanwhile, management fees continue every single year. Those fees may appear insignificant. 1% doesn't sound like much. But compound interest works in both directions. Imagine a tiny leak in a water tank. Each day, only a few drops escape. You barely notice. After 20 or 30 years, however, that small leak has emptied an astonishing amount of water. Investment fees behave the same way. A 1% annual fee may quietly consume hundreds of thousands of dollars over a lifetime, because every dollar paid in fees is a dollar that can no longer compound. John Bogle understood this better than almost anyone. He often repeated a remarkably simple idea. In investing, you get what you don't pay for. Lower costs leave more returns in the investor's pocket. That philosophy seemed almost boring compared to the excitement of stock picking. But markets rarely reward excitement over long periods. They reward discipline. Consider the rise and fall of famous companies. In the early 2000s, investors believed companies like Nokia and BlackBerry would dominate mobile technology indefinitely. Few imagined Apple would completely reshape the smartphone industry. Earlier generations believed Kodak would always define photography. Instead, digital technology transformed the market. Some businesses disappear. Others emerge from seemingly nowhere. An index fund doesn't need to predict these changes. As companies rise, they naturally become larger parts of the index. As companies decline, their influence gradually fades. The portfolio quietly adapts without emotional decision-making. This removes one of investing's greatest enemies, human psychology. People naturally chase success. When stocks rise dramatically, excitement spreads. News channels celebrate record highs. Friends begin discussing investments. Social media fills with stories of overnight fortunes. Fear of missing out begins taking control. History has seen this pattern repeatedly. During the dot-com bubble, investors rushed into technology companies regardless of profitability. During the housing boom before 2008, many believed real estate prices could only move upward. More recently, speculative assets experienced similar waves of enthusiasm. Every generation believes this time is different. Usually, it isn't. Psychologists Daniel Kahneman and Amos Tversky spent decades studying how people make decisions under uncertainty. Their work on prospect theory revealed that emotions often dominate rational judgment. Losses hurt more than equivalent gains feel rewarding. People become impatient during slow markets. They panic during crashes. They grow overconfident during bull markets. Index investing quietly sidesteps many of these emotional traps. Instead of asking which stock should I buy today, it asks a different question. How can I own the long-term growth of human progress itself? That shift changes everything. Think about what broad market indexes actually contain. Thousands of engineers building new technologies, scientists developing life-saving medicines, manufacturers creating better products, retailers serving billions of customers, software companies improving productivity, energy firms powering economies, healthcare companies extending life expectancy. Behind every stock symbol are millions of people solving real-world problems. As productivity improves, businesses grow. As businesses grow, economies expand. As economies expand, diversified investors participate almost automatically. Of course, nothing moves in a straight line. Markets crash. Recessions happen. Wars create uncertainty. Inflation rises. Interest rates change. Entire industries disappear. Yet history reveals something remarkable. Despite world wars, financial crises, oil shocks, pandemics, political uncertainty, and technological disruption, diversified equity markets have continued creating wealth over long periods. Not because every company succeeds, because innovation rarely stops. Creative destruction constantly replaces weaker businesses with stronger ones. Economist Joseph Schumpeter described this process nearly a century ago. Old industries decline, new industries emerge, economic progress continues. An index fund quietly follows that evolution. No forecasting required. No heroic predictions. No emotional reactions. This doesn't mean index investing guarantees profits. Short-term losses are unavoidable. During the global financial crisis of 2008, broad markets lost enormous value. During the COVID-19 panic of 2020, markets fell with breathtaking speed. Investors who focused only on recent headlines often sold near the bottom. Those who remained disciplined experienced something different: recovery. Not immediately, not comfortably, but steadily. The lesson wasn't that markets never fall. The lesson was that patience often outlasts panic. Warren Buffett once compared investing to baseball, with one important difference. In baseball, the umpire forces you to swing. In investing, you can simply wait. You don't need to chase every opportunity. You don't need to react to every headline. Sometimes the greatest investment decision is refusing to make unnecessary decisions. Ironically, this is exactly what many investors find hardest. Doing nothing feels unproductive. Checking portfolios every hour creates the illusion of control. Buying and selling feels like progress. But activity and achievement are not the same thing. Imagine planting an oak tree. You don't dig it up every week to check whether the roots are growing. You water it, protect it, then allow time to perform the hardest work. Investing often follows the same principle. Time is not merely helpful. Time is the strategy. The true power of index funds isn't hidden inside complicated mathematics. It's hidden inside human behavior. They reduce the temptation to chase trends. They minimize costly mistakes. They lower fees. They embrace diversification. Most importantly, they allow compound growth to work without constant interruption. Over decades, these seemingly small advantages become enormous. This explains one of investing's greatest paradoxes. The strategy that appears the least exciting often produces the most satisfying results. Not because it's perfect, but because it removes many of the obstacles investors create for themselves. Markets have always rewarded innovation, productivity, and long-term economic growth. Index funds simply provide one of the simplest ways to participate in that story. They don't promise to beat everyone else. They quietly aim to own nearly everyone. And over time, that simple idea has proven remarkably difficult to beat. The next time someone claims they've discovered the next guaranteed market winner, remember the quiet runner who never chased the crowd. Sometimes the greatest advantage in investing isn't moving faster. It's refusing to waste energy running in the wrong direction. The history of investing isn't just the story of extraordinary stock pickers. It's also the story of ordinary people who chose consistency over excitement, patience over prediction, and discipline over noise. Because in the end, wealth is rarely built by making the most dramatic decisions. More often, it's built by making fewer mistakes and giving time every opportunity to do what it has always done best. If this changed the way you think about investing, keep exploring the ideas behind markets, businesses, and human behavior. The more you understand how wealth is quietly built over decades, the less likely you are to be distracted by the noise of today.